this question right here, the cycle theory, we already did that in class. Do you remember that one, or do you want me to go over it?
Did you say the cycle theory?
Yeah, this one right here. The economic indicators and targets, real estate cycle theory, analysis, applications, intensity and duration. You want me to go over that one again?
I think if I have the notes from it already, I should be good.
Okay. Well, I'm asking the class too. Can you guys not hear me? Am I not speaking loud enough?
I can hear you. I think we're good.
Okay.
Or I'm good.
Okay. I'm not hearing input from a lot of people, so.
Majority of it's pretty straightforward.
Okay. So you have the notes?
Yeah.
Okay.
Thank you.
And those were videotaped and the video's put up there too. Okay, so this one, modern portfolio theory. Okay, this one's totally different. Okay, so we'll do that one next. How are we doing on time?
7:30.
How are you guys holding up these days?
Pretty good.
Yeah.
I'm not a big fan of it.
Yeah. You guys don't have, crazy siblings or anything like that driving you crazy?
Oh, I definitely do.
Oh, I'm sorry.
Nah, I got a sister that's actually making me want to go back to school.
Perfect. Yeah, I told my friends that I was not practicing social distancing. I told them I'm practicing anti-social distancing. And I act up on a daily basis. They thought that was kind of funny.
Gotta miss all my friends and everybody.
Yeah.
Kinda sucks.
Yeah. Yeah, what I've been doing actually is I've been setting up Zoom meetings with all of my friends that I haven't seen in a long time. So I'm kind of, because they're not out running around stuff, they're all at home. And so it's a great time to meet up with people.
Yeah. Great time to relax. I'd say put on a, game, but there are no games. So, kind of sucks.
You can watch reruns of the games.
I mean, that's what I've been doing. Me and GVT, we kind of got drunk watching the Warriors games.
Oh, did you? Oh, nice.
Yeah, it's pretty fun.
Yeah, I think I'm going to go back and watch the World Cup rugby match.
I'm not a rugby fan, so I wouldn't know.
It's a good sport. Okay, so the next one is modern portfolio theory. Okay, and you're probably getting some of this in your finance class, but what I've done is I've modified it a little bit to make it a little bit more relevant. And the theory basically states, okay, and this was based on, and actually my doctoral dissertation is on modern real estate portfolio theory. Markowitz invented modern portfolio theory, or MPT. What I did was I took his acronym and did MREPT, modern real estate portfolio theory, and post-modern real estate portfolio theory. So if you want to read the dissertation, that's what it's all about. And it's all application, actually, theoretical application. So modern portfolio theory or MPT, but we're studying MREPT. So we're doing modern real estate portfolio theory. And what we're doing is we're doing multi-asset class portfolio construction. Because the question is well, why would you put real estate in a stock and bond portfolio? What are the investment attributes for real estate that make it unique to the point where you would want to include it in your stock and bond portfolio? And the number one, you probably want to write this down. Real estate, because it's a physical asset and you're constantly putting money into the building to keep it up, you're spending inflation adjusted constant dollars in the capital expenditures to maintain the building. So you're putting currently priced materials and investments in the building to keep it up. By putting money in the building using current inflation adjusted dollars, the building value goes up with inflation. So real estate values track the inflation rate because you're plowing all this current inflation adjusted materials into the building to keep it up. So your cost basis in the building continues to go up because of inflation. It's not the case for stocks, and it's not the case for bonds. Real estate also has another inflation adjustment component to it that stocks and bonds don't have. And that is when I sign a commercial lease for a commercial property, in the lease there is a CPI, a commercial consumer price index, a CPI adjustment embedded in the lease, so that every year the lease goes up and tracks the inflation rate. So not only is my building going up due to the inflation rate, but my income is going up every year due to the inflation rate. That doesn't happen to stocks, and that doesn't happen to bonds. So that any movement in interest rates or inflation rates are highly stocks and bond prices and returns are highly sensitive to movements in inflation and interest rates. But because real estate has that capital expenditure, inflation adjusted cost basis, and CPI adjusted rental income, when interest rates and inflation goes up, prices of real estate normally don't go down that much or actually go up. So it's counter-cyclical to stock and bond returns. So if you're sticking real estate in your stock and bond portfolio, you're going to get diversification benefits. And that's what this presentation basically talks about. The correlation in the returns on real estate have low, no, or negative correlation with stocks and bond returns. Real estate returns have low, no, or negative correlation with stock and bond returns. Therefore, it is an ideal diversifier to put in your stock and bond portfolio to get diversification. Okay. Does everybody follow the thesis?
Yes.
Okay.
Yes.
Okay.
Yeah.
And in your quantitative analysis class and in your finance class, you should have been talking about, correlations. Now, here's the, this is the y-axis, this is the x-axis. Along the x-axis is the standard deviation of the portfolio. So it's the risk of the portfolio. And you already know how to calculate that because that was in your pretest. And then on the y-axis is the expected return on your portfolio. Then this is how I would draw this out if I was going to teach this to somebody. Is I would start here and I draw the line like that. This line is called the CAL, or the capital allocation line. Then what I would do is I would go here, put a dot right there, go like that, and then like that. And put a dot right there, and put a dot right there. Got it. And actually the capital allocation line intersects in the expected return on the portfolio at the risk-free rate. So this is like your 10-year treasury yield, which is also the risk-free rate, the base rate. And obviously as you take on more risk, you're going to expect more return. And then what I would do is I would go like this. Okay. And that's called the efficient frontier umbrella. Okay. And these points right here on the efficient frontier, points along and on the efficient frontier, and points inside the efficient frontier. All of those are portfolios that I can construct by pulling assets from the markets that are available to me, and I can construct them into a portfolio. These are all feasible portfolios. Now, I don't want a portfolio over here, right? Low return and high risk. No way. I would want high return and low risk, but there's no assets, there's no portfolios available in the marketplace. This is the only point where you have feasible portfolios that I can actually construct. Then what I would do is right here, I would go like this, and like this, and go U1, U2, U3. And what these are called are utility curves. These are utility curves, and they represent risk-averse investors' utility preferences. So obviously, the investors want to be up here, high return, low risk, but there's no portfolios out there for them. So they have to lower their utility. There's no portfolios out there, so they got to continue to lower their utility to the point where the utility curve is tangent to the capital allocation line in the efficient frontier. That is called the market basket. So that market basket represents the proportion of assets in the capital markets. For example, let's say 70% of the market or 60% of the market is made up of bonds, 30% of the market is made up of stock, and 10% of the market is made up of real estate. Assets that can actually be put into a portfolio. So that's the market basket, that's the market index. At that point, and I would put these in, at the market basket, this is the star, this is portfolio star. At that point, the investor is getting the highest risk-adjusted rate of return. So we have my expected, I have my expected return on the portfolio divided by my standard deviation on the portfolio. This is my risk adjusted rate of return. Got it. And at that point you're maximizing this. You're maximizing the risk adjusted rate of return. Now I can invest all of my money in stocks. So that point is 100% stock portfolio. Well, at that point, I'm going to be taking on a lot of risk, but I'm also going to be getting higher returns. I can, if I want low risk and I'm willing to take on less return, I can sell off my stock and buy 100% bond portfolio. So I can move, if I want higher return and I'm willing to take on higher risk, I can sell off my bond portfolio, buy more stock, get higher rate of return, but I'm taking on more risk. If I want to reduce my risk and I'm willing to take on less return, I can sell off my stock portfolio, buy more bonds, move down the efficient frontier, and get a 100% bond portfolio. Okay, any questions yet for that?
No, that was clear.
Okay. And then what I like to do too is I forgot to put my expected return on the bonds and my standard deviation for the bonds. Got it. Okay, that all looks good. What I can do too, as an investor, is I can actually jump off the efficient frontier. Hold on. I can actually jump off the efficient frontier. Darn it. Hold tight. I can jump off the efficient frontier and move up the capital allocation line to a higher point there. And at that point, I'm taking on a lot more risk. But I'm also getting significantly higher return. So how do you do it? You do it through the process of leverage. In real estate is a highly leveraged asset. Most real estate investors want to put up as little money as they can and borrow as much money as they can. So if the price and the value of the property goes up, their return on equity goes up exponentially. But if the value or the price of the building goes down, because they use leverage, their return on equity goes down exponentially. So leverage is a two-edged sword. It's great when prices are going up, exponential increase in your equity return, but when values and prices go down, your rates of return on your equity go down exponentially. So in real estate, the way that you leverage up your returns is through the use of a mortgage. So me as a developer or a real estate speculator is I can borrow as much money as I can, put up the least amount of money that I can, leverage up my returns when prices are going up. I'm taking on a lot more risk, but I'm getting compensated with significantly higher returns. Now, investors can also jump off the efficient frontier here, down here, and move down the capital allocation line, let's say to here, this is leverage, risk. This is leverage, returns, and this is going to be your expected return from the process of lending. And that's what banks do. Banks are not worried about, they're not interested in getting high returns. What they're more interested in is not losing any money. So what they're really focused on is lowering the risk. And they're willing to take a lower rate of return. So what they'll do is they'll lend on properties. You as the borrower you don't own the building. You only own the building. You only own the building when you pay off the mortgage. Then you get the title to the building. So the bank will lend you the money. They will use your credit. They'll check your credit to make sure you're credit worthy. But they'll take your property, and that'll be the collateral to back the mortgage. So that if you ever default on the mortgage payments, the bank will foreclose on the property and take your property to pay, and then sell off the property to pay off the loan. It's the same thing with the brokerage firms. Brokerage firms are more than happy to lend you margin to buy the stock. But if the stock price goes down and you can't put up the margin call, they're going to sell off your securities to pay off the loan. So margin up here. You can use borrowed money to buy stocks on margin to leverage up your equity returns. And the brokerage firm is more than happy to lend you money for the margin account But if the stock prices go down, you're going to get a margin call. If you don't put up any money, they'll sell the stock and they'll pay back the the margin loan that you took out to buy the stocks. Okay, are you guys all clear on this so far?
Yeah.
Yes.
Okay.
Yeah.
Awesome. Got it. Okay. So the next thing, which is interesting, is that I want to see what we can do now. Okay. Over the decades, this market basket has changed. In the, I would say through the 20s to the 1950s, when you went to an investment advisor, they would construct a portfolio for you, and it would be 70% bonds and 30% stock. And it wasn't until the 1970s and 1980s that a company called Ibbotson and Associates So this company called Ibbotson and Associates ran this analysis and said, oh my God, what we did was we included real estate in the stock bond portfolio. And we ran the correlations and the returns. And we noticed that real estate's returns had a positive correlation with inflation. And it had low, no, and negative correlation with stocks and bonds. And what actually happened was when we ran the analysis, something very interesting happened. The efficient frontier bowed out. Because real estate has low, no, and negative correlation on the returns with stocks and bonds. So it bowed out the efficient frontier. And we noticed that the expected returns went down, but the risk, the portfolio standard deviation, went down even more. So the risk-adjusted rate of return actually went up. So the investor was actually better off on a risk-adjusted return basis than they were before. Therefore, Ibbotson and Associates recommended that all institutional investors should have at least 10% of their multi-asset portfolios allocated to real estate. And it was such a powerful research that Congress passed ERISA, which was a labor act, a labor law, that basically stated that public and private pension funds should have at least 10% of their portfolio allocations for their pension funds should have at least 10% allocation into direct real estate investment. That institutionalized commercial real estate. Everybody follow so far?
Yes.
Okay. And then the key here too is that what investors are looking for is an expected return of between 8 and 10%. So if I can put together a portfolio for my clients and I can lock in their expected return of between 8 and 10% under the rule of 72, if I can get my clients a 10%, if I can get my clients a 10% rate of return, how long would it take me under the rule of 72 to double the value of the portfolio? Question. Under the rule of 72, if I can get my clients a 10% rate of return, how long would it take me to double the portfolio?
7 years.
Yep, 7.2
Yeah.
years. Got it. So if I can get my clients between 8 and 10% rate of return and lock that in, I can double their money in less than 10 years. I'm in as a multi-asset portfolio manager. I'm giving my clients what they need. And because I'm bowing out the efficient frontier, reducing the risk of the portfolio through diversification, I'm increasing their risk-adjusted rate of return. I've done my job as a consultant and as a pension fund advisor. Okay? You guys get it?
Yes.
Okay.
Yep.
And then in 1990, this gets a little bit interesting. In the 1990s, in the 1990s, Ibbotson did some more research and said, oops. Sorry. Ibbotson did the research and the analytics again and found out that if you added cash value life insurance into your stock bond portfolio, that you should have up to 10% of your allocation of your portfolio in life insurance, along with real estate. And in the 1990s, this was cash value life insurance was institutionalized. Actually, a lot of these life insurance companies invest in huge portfolios of real estate. The banks started putting cash value life insurance on all of their directors and senior level executives in the company, started to pay the premiums on these life insurance policies that accumulated cash value in the life insurance policies. And if one of the principals passed away, the bank would be injected with the death benefit. So the cash value, the regulator said, is highly liquid, and you can use it as tier 1 capital liquidity when we come in to examine your bank. So that institutionalized cash value life insurance. And then in the 2000 period, which is where we are now, a company called Deutsche Bank Reef. These guys are institutional real estate investors bought by Deutsche Bank out of Germany. Did the analysis again and said, we need to reduce the allocation to bonds because they're more volatile now. We're going to keep the allocation.
Can you lower the camera again?
Yeah, thank you. Thank you. We're going to take from the bonds again. We're going to keep the allocation to stocks. We are going to keep the allocation to real estate. We're going to keep the allocation to cash value life insurance. And we're going to put a new asset class in there that actually looks, smells, feels, but is different than real estate. And it's going to be alternative renewable energy. Solar farms, what do they sit on? All of those arrays, what do they sit on? Hello?
Energy?
Yeah, the solar arrays, when they're on these huge solar farms, what do they sit on?
I have no idea.
What are they on?
Land.
Land, got it. And what's land?
Okay.
Real estate, got it. Okay. What about the wind turbines? What do they sit on?
Also land.
Land. Okay. What about geothermal plants?
Land.
Land. You get it? Okay. So these are the market baskets that have basically changed over the decades as new asset classes have emerged. The new real estate asset class is alternative renewable energy in data centers and cell towers. So the definition of real estate is changing, but the attribute is the same. The rates of return on renewable energy, insurance, direct real estate, and real estate have low, no, and no correlation with stocks and bonds returns. So thereby, by adding these alternative assets into a stock bond portfolio, it bows out the efficient frontier. Yes, it's going to lower the expected return on the portfolio, but the risk of the portfolio is going to be reduced even more, which is going to increase the risk-adjusted rate of return. And if I can get my clients an 8 to 10% rate of return, I can double their money in less than 10 years. We're in. Bingo. Game over. That's how it works. Oh, and there's one more piece to this thing that's really interesting. Is a lot of these real estate investors and these groups of real estate investors are extremely rich and powerful individuals and extremely rich and powerful families. And each one of those people within the family, particularly the people who run these groups, have a ton of life insurance on them. A ton of life insurance on them. They spend a lot of money on life insurance. Why would they do that? Because they know if something ever happened to them, that the company and the assets and the nonprofits and the political lobby groups and the everybody, the family and the families around him would be impaired significantly if any one of those principals died. So they get tons of life insurance on these individuals, so that when the individuals pass away, the death benefit goes into the estate, goes into the portfolio. And when the money flows in to the portfolio, the expected return on the portfolio jacks to an extremely high level. And the death benefit pays all the taxes, pays off all the debt, and pays and then pays to hire more people to take over for the person that just passed away. And the portfolio jacks the portfolio onto extremely high expected rates of return, and the stakeholders around the estate end up on a higher utility curve, which is where they wanted to be from the very beginning. So it's amazing how powerful you can assemble these portfolios by using different asset classes from different areas in combination with real estate. Any questions on that?
No.
No, it's clear.
Okay. I think that answers everything in there. Okay. All right, how you guys doing? What time is it?
8:12.
Do you want me to keep going, or what do you want me to do? Go to the next one?
I think it depends on when you would like this to be fully turned in.
Yeah, I think I'm not worried about it because there's so many other things that you need to do. Why don't I do the next two, and then we'll be done, and then we can come back next week and finish off the rest of it.
Perfect.
And then you're done, okay? And that should
That
be,
sounds good.
yeah, okay. And then, so let me erase this, okay? Because the next two aren't too bad. This one's a little hardcore. And I actually developed a lot of this myself. Markowitz kind of set this up, and then I had done a lot of research on the real estate side, so I understood the bowing out piece, and then I worked in insurance for like 5 years, so I learned that insurance piece, and then over the last 10 years I've been working in alternative renewable energy. So I kind of put this all together about, I think it was maybe 7 years ago I put this together.
You go.
You guys holding up good?
Yeah, we're good.
Okay.
Yeah, not too bad.
Okay. At least you don't have to commute, right?
Nope.
But sitting's hard, isn't it? Sitting, laying around.
Yeah.
I was pretty sore the first 2 weeks.
So boring.
It's just I got sore. Okay, so the next one is dynamic asset class supply demand analysis. Okay, and actually I go over this too in that video lecture at the bottom of the course website where it says Introduction to Commercial Real Estate. There's a lecture on this in there. Okay. So let's see if I can do this right. All right. Okay. So I'm going to start off with your basic, microeconomics, supply demand analysis, using the Marshallian, graphics. And you have your supply curve, you got your demand curve. Both the supply curve and the demand curve are elastic, okay, in this case. Where the supply and the demand curve intersect, that's the optimal quantity at the equilibrium clearing price, right? That we all know that stuff. But real estate is different. Real estate's supply curve, this is an elastic supply curve. But real estate supply curve in the short term is completely inelastic. Because we can't, if the demand curve, for example, we get a demand shock, well, the quantity demanded is going to move up. I can't instantaneously, out of thin air, develop millions of square feet of real estate instantaneously, because in real estate, unlike stocks and bonds, if I get a demand shock in the stock of the bond market, the investment bankers could basically underwrite and issue stocks and bonds in, I don't know, a week or two. Or if I have the shelf registration of my stock is sitting there and all of a sudden I get a demand shock, I could just start issuing shares instantaneously. But real estate, if I get a demand shock, usually generated by employment, I got to spend some time to go find the land, to hire the architect, to submit the plans, to get the permits, to get the loan, to start the construction, to complete the building, to get the certificate of occupancy, to lease up the building. That could take, I don't know, in San Francisco, Salesforce Tower took 10 years. Most office buildings in San Francisco take 5 to 7 years to build. In Phoenix, I could build a building in probably a year or two. It's different. But real estate is different. In the short term or in the short run, the supply curve is purely inelastic. And when you get a demand shock, it's going to cause the quantity demanded to increase and the prices to go up. And there could be prices, could be rents, it's the same thing. Now what happens for real estate, let's assume that the markets that we're talking about are not supply constrained. These are normally function real estate markets. What will happen is the over time, oops, actually should go like this. Over time, the supply curve is going to shift out due to new construction. The market is going to go back into equilibrium at a higher quantity supplied. But the problem is that in this example here, there's two types of markets. There's commodity markets and there's supply constrained markets. Now the supply constrained markets are Seattle, maybe Portland, definitely the Bay Area, definitely LA, definitely Boston, Cambridge, Massachusetts, definitely New York, definitely Washington, D.C. Those are the supply constrained markets. So the markets never reach the long run or the long-term equilibrium point. So what happens is the supply curve never reaches equilibrium. It gets stuck, basically. And the price of the real estate stays high because the market can't respond to the marketplace. It ends up at a higher price because the market is constrained. The worst case scenario is if you're in a commodity market where actually the supply curve overshoots demand. And prices actually fall. So supply constrained markets, which you'll see, is that prices will remain elevated. The appreciation rates for the price appreciation rates for the supply constrained markets are well above the local inflation rate. So supply constrained. And the commodity markets, what you find is that they overshoot because there's too much land. They like to use commercial real estate development, residential real estate development for economic development purposes, so they promote construction, which ends up overshooting, causing the prices and the price appreciation rates to fall significantly. And the worst case scenario is not only do you get high supply, but you also get low demand. That's called a recession. And in that scenario, not only did you get high supply, but you got low demand. And that's when prices basically collapse. So that's basically that one. Do you have any questions on that?
No.
Seems pretty standard.
Yeah. The key to that one is the supply curve doesn't shift out to its equilibrium. It gets caught in between in the supply constrained market that keeps the price appreciation rates and the prices higher. San Francisco is a perfect example. Hong Kong, Singapore, Shanghai, London, Berlin are good examples of global markets like that. But commodity markets are Sacramento, Fresno, Stockton, Albuquerque, Salt Lake City, Utah, Texas, Phoenix, Atlanta, the South, southern Chicago, all the areas that have tons of land. Okay, almost done. Okay. So the last one, and we already went over this a little bit. Okay. And then the last one is the intrinsic valuation models. So the first model is the perpetuity model. And the perpetuity model for valuation is the net operating income. Got it. Next year. And the assumption is that the net operating income is going to remain flat into perpetuity forever. So the NOI is a constant. And in real estate, we used stabilized net operating income. So we use a year of net operating income that's stabilized, durable. And then we divide that by the discount rate or the expected rate of return. So your I is the discount rate. Could be the weighted average cost capital. It could be the capital asset pricing model, right, which is your expected return on your equity. Those are usually what your discount rates or your expected return. Got it. And that's going to give you the value of the real estate under the perpetuity model. And we know that if we think that net operating income is going to go up in the future, the value is going to go up. If the expected returns or the discount rates go down, then the value of the property is going to go up. If the net operating income is expected to go down, value goes down. If the expected returns of the discount rates go up, then the values go down. Okay? Everybody get that?
Yep.
Okay. Then the second model is the Gordon growth model, or the constant growth. Constant growth, or Gordon growth. And the Gordon growth is basically your net operating income next year stabilized, divided by the discount rate minus the growth rate of the net operating income at a constant rate forever. So it's I minus G. This is going to give you the value of the property or the real estate under the Gordon growth model. So it assumes that if the expected growth rate in net operating income goes up, the property value is going to go up. If the expected growth rate in the net operating income is expected to go down, then the value of the property goes down. Okay?
Got it.
Okay. And then the third model what? What'd you say? No? Okay. The next is the gross rent multiplier, or the multiple approach. Okay. So this, basically, you're going to take the gross rent, and you're for next year, and you're going to multiply it by the gross rent multiplier to get the value of the building. So what you're going to do is you're going to take the sales price of comparable buildings, and you're going to divide it by the gross rent to get the gross rent multiplier. And that's the gross rent multiplier approach. Okay. Any questions on that?
That one's the easiest.
Yep, that's easy. Okay. And then the last one, we already went over it. Which is the DCF. And you're trying to calculate the present value under the DCF. And you're going to take the net operating income over the holding period divided by 1 plus your discount rate. Right, so you're going to take the sum of the discounted net operating incomes plus the terminal value, 1 plus I to the n. We already know how to calculate the terminal value because we did that earlier. You discount this all back to get the present value. Now again, if you know what the cost is, now let's do the capital budgeting. We know what the cost is, or the purchase price. We subtract out the cost of the purchase price from the present value. We're going to get the net present value. And if it's positive, you're going to accept it. If it's 0, you're going to accept it. And if it's negative, you're going to reject it. Okay? I think that's all I got. Okay?
Got it.
All right. So I think that's all I can do, and then I'll finish these last two next week. We can I'll start working on some of the problems for the midterm. I think you guys got enough to work on, and then we'll just keep going from here.
Awesome. Thank you.
All right, sounds
Okay.
good.
So you guys take care of yourself. You know, be happy. And tell everybody you appreciate them, respect them, and love them. And we'll get through this hopefully within the next month or two.
That sounds like a great idea. Thank you, Professor.
All right, you guys. Thank you. I
Have a good
appreciate it. I appreciate everything you guys do.
Same here.
All right.
Ew.
Hey, Professor. Oh, I was just gonna say if I could
Yeah.
copy down number 4.
Yeah. Can you hold on a second?
Yeah, no problem.
Yeah. Hi, Arlene. How are you?
I'm doing well.
Good.
Yourself?
Nice to hear your voice.
Yeah. Thanks.
How's Nicole doing?
She's doing good. She had a really bad headache actually
Oh,
today.
that's too bad.
She's resting.
Yeah.
So
Now, are you guys still working, or what are you guys doing?
yeah, we're in real estate finance together. So we have a lot of projects that we're working on together.
Oh, that's awesome. Oh,
Yeah.
good. Was any of the pro forma and stuff like that helpful for you?
Yeah, it was. We haven't covered it yet,
Okay.
but we have been covering valuation methods.
Great.
So everything that you said was just refresh
Good.
what we already learned.
Great. And then what book are you guys using, and what templates are you using?
We don't really have templates.
Okay.
He just kind of provides us like an Excel sheet
Okay.
with all the formulas set in, and then we'll just go over that in class.
Okay.
But it's been a lot more challenging now that we're working on Zoom because we're not
Yeah.
able to like practice that much. He's kind of just demonstrating what he's doing.
Sure.
Yeah.
Well, if any of the spreadsheets, you know, that I have are helpful, or if you need to take a look at anything, or, you know, give you some comments on anything, just let me know.
Oh yeah, that'd be great. I appreciate it.
Yeah. What else can I do for you?
I think I'm good.
Oh, okay.
Yeah, thank you though.
Yeah, and then
If I have any questions down the line, I'll for sure let you know.
yeah, and then what do you guys do in your paper on?
Sorry, our research paper.
Yeah.
Well, we've been brainstorming. Nicole likes to cover development a lot because that's
Okay.
like what her family does. So
Okay.
probably something in the development sector.
Okay. Did you want to do like a quick and dirty underwriting on a project?
We could. Yeah.
You want to pick a project and underwrite it? Does that,
I can ask Nicole.
yeah, have her, I mean, if it can be done, you know, without too much brain damage,
Yeah.
I mean, if she can, you know, do some research and, you know, underwrite a property and then present, you know, that underwriting to us, that would be pretty awesome.
Cool. Yeah, I'll let her know.
Or if she, you know, she has a project, you know, that's been underwritten already, you know, she could walk us through the underwriting process.
There we go.
Hi.
You can see me now.
Yeah.
Hello.
She could walk us through the underwriting process. Do they actually have like pro forma income statements that they could show us, or
I'm
is it
not sure,
proprietary?
Maybe. Her dad has been helping us a lot with our finance,
Yeah.
like projects and stuff. So I'm sure he's really willing to, you know, show us some stuff.
Yeah, because the financial modeling
Yeah.
is like the core technical piece, and
Yeah.
then doing, you know, the layers, you know, the development process, right? And then
Yeah.
you do the feasibility analysis, you know, highest and best use, or, you know, whatever you want to call it. But then you have to put together a report, right?
Yeah.
To present to the investors and the bank and the community and the, you know, politicians and all those people.
Yeah.
And maybe we could, you know, redact it so, you know, nobody knows what the project actually is. You know, we could redact it, but still walk through the process.
Yeah.
You know, and show the investment analysis. You know, how did they make the decision?
Yeah.
You know, to do
You
it.
know, she actually has. They just built. I don't know how many units it is, but it's for sure over like 20 units in Walnut Creek.
Oh, nice. That's
Yeah,
a good
it's really
market.
good. Yeah. So I'm sure we can pull some information, even do it on that one too. I'll ask her about it.
Yeah, that would be really cool, because I don't underwrite anymore, so I don't have any current underwriting packages, because I would have brought that in, except for that old one that I did in 2000, you know, which was,
I remember that one.
yeah, that was a pretty heavy deal. That was hardcore, because it was affordable, and it was 150 units, and it was highly politically contentious. So we were, you know, but, you know, it worked. It was a good project. It did get built. The redevelopment agency ended up developing it, and it was the last one they ever did.
Oh wow.
Yeah, because the redevelopment agency should not be building affordable housing. It should be the nonprofits.
Mm-hmm.
So when Willie Brown had the the redevelopment agency starting to infringe in the community into affordable housing development, which in hindsight, it probably wouldn't be a bad idea from a supply standpoint, but usually most government agencies have really bad architecture, you know, and it's just ugly. So, but that would be cool if, you know, especially the financial modeling, you know, is really the core to the whole thing.
I'll write that down.
And then
Yeah.
really,
Writing everything down so I can go over it with her.
And then really it would really be dependent on the degree of disclosure
Yep. Yeah, that's true.
from her I mean, you don't even have to say it's in Walnut Creek.
Yeah.
You know, you could just say it's in a suburban location in the Bay Area.
Yeah. And we actually used it for one of our presentations for finance.
Oh, you did?
So,
Nice.
yeah, so I'm sure she won't have a problem with like disclosing little information,
Okay.
but you're right when it comes to actual like financial modeling and that type of stuff. Yeah, she'd probably just have to get permission.
Yeah, because that's really key. You know, is how did you build the construction budget? You know,
Yeah.
what was the total cost of construction, and how was it broken down between hard and soft costs?
Mm-hmm.
And then, is this a market rate apartment building, or was it sold as condos?
Honestly, I don't know that.
Okay.
Yeah, I don't know that much about it.
Okay.
I'm pretty sure it was not sold as condos.
Yeah, and then the obviously getting it approved, the plans approved, to get into permits, to do the construction, to get the construction loan, obviously, and then once you've built it, then you lease it up. Then you're going to refinance it, take out the construction loan, and then the developer's going to get, a fee, right? And then does he asset manage it afterwards? So not only did he build it, he either sold it or owned it, but the net present value, had to be extremely high.
Yeah.
To take on that risk.
And especially in a time like right now.
Yeah,
like
well, is it delivered?
What's that?
Has it already delivered?
Oh, yeah. Yeah.
Oh, okay. So it's delivered, stabilized.
Okay.
Yep, so it's already seasoned, it's been there for a while.
Yeah.
Usually in these situations, he's going to have to drop the rents.
Yeah.
He's probably going to have some vacancy, but usually what happens is apartment buildings in those locations, Walnut Creek is a primo submarket.
Yeah.
The rents will drop, but people will flood in to that because it's a newer building and it's in a great location.
Yeah.
So their economic occupancies, have a floor to it, and their rents have a floor. Mm-hmm. And when the markets turn around, they're the first to see the occupancies spike, and then they could start pushing rents again.
Yep, that's true. But when will that be? Like a few months from now, or what do you think? We don't.
No, the real estate market hasn't been through the worst of it yet. The stock market's taking most of the hit. The bond market, except for residential and mortgage-backed securities, have gotten slaughtered. But the Fed stepped in and bought a bunch of the paper to stabilize the market. And then now we're waiting to see the default rates on the rents, because some apartment buildings are going to get hammered because people don't have the rent to pay.
Yeah.
They're not going to pay it. And then that will flow through at some point to valuations. And then that will flow through to mortgage payments, mortgage defaults, and then we'll see if the banks foreclose, on these building owners, or they work out the mortgage payments in the mortgage structure, so that they don't have to take the building back, which is most
they don't want it.
They don't want it. No.
Yeah.
So we haven't even gone through the real estate bloodbath, and we'll see what happens over the next 6 to 12 months.
Yeah, I know, it's crazy. Whew.
All right. Did you have anything else?
No, I think that was all.
Okay,
yeah, but
cool.
it was nice to speak to you and know that you're doing well and
Thank
your
you.
family's well.
Thank you. Yeah, you too.
Sure. Thank you.
Yeah.
Yeah, so if I have any other questions, then I can just shoot you an email or a text or whatever.
Yeah, and I'm booking appointments for next week too. So if you wanted
Okay,
to,
on Zoom, like Zoom calls.
yeah.
Okay.
I mean, if you want to set one up now, we could do it,
Mm-hmm.
or I'll send you.
I would have to see because I do work as well, like
Okay.
online.
Oh, okay.
Yeah, I'll just shoot you a text and see if we could set one up. Because I'm gonna get started on the midterms. I need to.
Okay. And then
Yeah.
I'm open all day on Monday, April 13th.
April 13th. Okay.
Yeah,
I'll make
I'm-
note of that.
Yeah, I got no appointments as of that day, and nothing really in the afternoons on Thursday.
Of next
And-
week.
Yeah, and Friday.
Okay. Sounds good.
Okay, cool.
Okay, awesome. Well, then I'll just see you next class, and if not,
Yeah.
then maybe have a meeting on Zoom.
Perfect. Yeah, say hi to Nicole for me.
Yeah, of course I will.
Okay.
Right, Professor. Good night.
You too. Take care of yourself.
Thank you. Bye bye.
Richard, how are you?
Good, thanks yourself.
Good.
Right.
How's the weather?
It's pouring here at the moment.
Oh, nice.
Very good. How about you guys?
We're good. It was a beautiful day up here in Nevada.
I'm very jealous.
Yeah, it was. Although I've been living in my garage for 2 weeks,
I love that, don't you?
but I can actually open the garage every now and then, so it's kind of nice. It's actually
I didn't realize. Oh, that's funny.
Yeah.
Sorry, Professor.
Yeah.
I did have a question for you though. I was just wondering if you could check my deliverable.
Oh yeah.
I know at the start of the session I was
Sure.
having trouble uploading the memos and my quiz notes. That's what made sure they're there.
Okay. I thought I did go through this.
You went through them, but my for my quiz notes and my memos, they were missing. I just want to make sure that you got them on your end. If that's
Yeah.
right.
Yeah. So your memos look good. And
They're
then
there?
yeah, and then the quiz. What is? Are these just? Oh, I see how you did it.
That was the first lot of notes we took.
Oh yeah. So you're still working on that.
Yeah. So everything that I did today, I'll also add to it.
And then you got a chapter presentation, which is good. You got your article review worksheets. Make sure you put the articles in there.
Did they not go through either?
Pardon me?
So they're not attached at the moment.
Oh, are they in there? I just didn't.
They should be, but yes.
Okay, I'll take another. They're JPEG, so I thought that they were just pictures.
No worries, all good.
Okay. And then the movie review looks awesome. And then the statistical pretest, awesome. And then your resume. Did you work with the Career Center at all?
I did, yeah. I know you. Yeah, you said that last time as well. So
Okay.
I worked with them, so I'm not too sure. I'll take it back to them. I'll say, what can I do to make it better again?
Let me just remind me, and I will forward on to you some. If you send me an email, I'll attach some resume samples from
Awesome, thank
some
you.
of my students, and then I'll give you those, and that might be a good template for you.
Beautiful. Thank you. Yeah, I was working with Kelly Davis a couple of weeks ago, so
Okay.
that's why I thought it was. Yeah, no worries. I'll fix it up for you.
Okay.
Thank you very
cool.
much, Professor.
Yeah, you're welcome, and thank you, and I hope your family's doing well.
Same to yours. Look after yourself. I'll see you next week.
Great. Keep in touch.
Absolutely.
Nice,
Thank you.
nice to hear from you, Richard.
Good to hear from you too, Professor.
Take care.
See you.
Bye bye.
Is it over?
It's over.
Okay, we're ready to eat whenever you are.
All right.